Good evening, everyone, and welcome to our first lecture for Indiana University South Bend School of Business and Economics, Financial Management, BUS D502. We will have 4 class meetings that will be roughly 2 hours and 40 minutes for each session. And the first meeting is online, as you could tell, or via Zoom. The next 3, if all goes well, will definitely be in person. I am Jim Rose. I will be the course instructor over the next 4 courses. A little bit about myself. I'm the Vice President of Finance and Principal Accounting Officer for Patrick Industries, which is in downtown Elkhart. If you've ever had a chance to pass by beautiful downtown Elkhart across from the Lerner Theater, that is kind of where my life tends to operate most days and many hours of the day. I arrived here about 3.5 years ago from Atlanta, where I was working for large paper and packaging company, WestRock. And before that, spent time in the Austin, Texas area, about 8 years in the Denver, Colorado area, working for a variety of large corporations doing various finance and accounting functions. So to move to the syllabus, I'm going to share the screen. Again, this syllabus, work in progress, subject to revision. But generally, we're going to follow the first 9 chapters of the McGraw-Hill Essentials of Corporate Finance. And it's a decent book, and it has some PowerPoint slides that are useful that I will be utilizing in further lectures. Has some useful assignments and exercises and quizzes that can be useful in adding structure and detail to the course as we go along. But in general, we're going to be covering just the basics of how decision makers in the corporate environment evaluate financial results, plan and value businesses and decisions and results. And we're going to be going through some basic categories in finance, such as the time value of money, risk and return, capital asset pricing models, otherwise known as CAPM, cash flow analysis, valuation techniques. And again, the objectives are to demonstrate knowledge, comprehension and application of terminology and principles of corporate finance, become familiarized with types of business, organizational structures and their implications for corporate finance, display basic knowledge for the calculation and interpretation of time value of money principles, and understanding the basic fundamentals of bonds and stocks, using the principles learned in the course for application of capital budgeting problems faced by businesses. But to really kick it off, I need to get kind of my hands dirty in my own world and kind of share with you how I would begin to just cut to the chase about why this course is relevant, what we're going to learn, and what is my thought process. Having spent 17 years in corporate America in various capacities, working for a company right now that is publicly traded. It's on the stock exchange. We have earnings releases with investors. We have Wall Street calls with our analysts. We're purchasing companies. We're valuing companies. We're issuing financial statements. We're making financial decisions. You have 11,000 folks that work with us every day, making products, selling them, and affecting our revenue and affecting our profit. So what is the first thing that I do if I'm thinking about companies, if I'm thinking about finance, if I'm thinking about stocks? Where would I first go? A lot of places, but I could start with something that's fairly digestible and that's fairly accessible to all of us. So I'm going to share the screen again. Let's see here. Let's find the Chrome. Yahoo Finance, right? So you just Google Yahoo Finance and you're going to arrive there. It's kind of an old school website, more for the perhaps baby boomer generation. I don't know if anyone's familiar with Yahoo Finance, but it's a nice basic place where you can start to do some stock research, which kind of gets the ball rolling for our evaluation of financial statements and different corporate finance concepts. So you think about it, a company that is publicly traded means you can buy shares in that company, and those shares represent ownership in that company. And if you think about the different products out there that you're interested in, whether it's Zoom, which is where we're recording right now, that's a company. So we could go to Zoom right now. And so what I'm about to enter in is the ticker symbol. The ticker symbol is just the symbol that Zoom goes by that will allow you to get the stock market information for. So let's go to Zoom. Let's see here. Zoom video. So their ticker symbols is ZM, right? And finance, help me out. Now, Zoom is currently trading at $108.94. And of course, Zoom has been trading over a certain period of time, and we can look at that trading history through looking at a stock chart. Look at this. Look at Zoom trading over time. Let's see here. Let's look at Zoom over the last 2 years. Okay, so Zoom 2 years ago rocketed all the way to $550 per share, and now is trading a little bit south of $150 per share. That's very interesting. That's very interesting. Okay, so Zoom was trading at $550, and now it's trading at $150. Okay. So Patrick Industries here. So it says Patrick Industries is trading at $69. Again, what does that mean? It's trading at $69, and it says it has a market cap of $1,600,000,000. I wonder what that means. When these companies are traded and they have these stock prices and they have these market capitalizations, market capitalization is how much it costs to buy an entire company. So if you took, if a company had 1 million shares and its stock price was $50, theoretically, it would cost you $50 million to buy that company. If you had $50 million in your bank account, you could go to your brokerage account and you could buy all those shares, or you could make an offering for all those shares. That's the dollar and the kind of the value behind a company. But the question is, okay, so went to Yahoo Finance. We saw these stocks, we entered in a ticker, we saw the stock price. The concept of market capitalization is the value of the company, okay? So if you had 1 million shares outstanding, each share was trading at $50, the company is worth 50 million. So if someone was to buy them, or if you had enough money in your bank account to buy a company, it would cost you $50 million. Okay. $50, 1 million shares outstanding. Where does the $50 come from? How did we decide that something was $50? Okay. The stock is fluctuating over time. Why? Okay. Well, people are buying and selling those shares. Those are investors, right? Those are investors with trillions of dollars all throughout the world, buying and selling the shares of Zoom or Patrick at a certain price, okay? And the trading of those shares and the resulting market capitalization, and again, market capitalization means how much a company is worth, how much it would cost if you wanted to buy that company. If you wanted to buy Zoom and completely own Zoom, right? So Zoom, let's go back to Zoom. Let's go back to Zoom. Zoom video. Zoom video. Zoom video is trading at $108.94. Okay, what does that mean? Well, if we multiply 108.94 by the shares outstanding, we get to its market cap. And you know, Yahoo Finance is nice enough to do the math for us. And they're saying that the market cap right here, the value of the company, how much you'd have to pay if you wanted to buy Zoom, okay? You want to own all of Zoom. $32.46 billion, okay? So almost $33 billion. That's what Zoom is worth. Zoom is worth $33 billion because of the price investors are paying for the stock multiplied by how many shares are outstanding of that stock. And a share represents a ownership. So if there are 100 shares outstanding for a company, right? And you own 10 out of those 100, you own 10% of the company, okay? But that leads us back to the question I asked earlier. $108 a share, $33 billion market capitalization. Zoom is worth $33 billion. How on earth did we get there? Who's coming up with this valuation stuff? Like why does it make sense that Zoom even has that value or that there's a stock price? Well, the answer to that question is that there is financial information. There is financial information that is published on a periodic basis. We're going to get into the details on this. Okay. There is financial information that is published 4 times a year, sometimes a little bit more frequent, depending on what's going on. And the investors use that financial information to make decisions about how much they would or would not pay for shares of Zoom, for example. And now we are going to get into what that financial information is. And we're going to familiarize ourselves with the basic meat and potatoes, blocking and tackling of what financial information is. Now, my background is with publicly traded companies. So I've never worked for a private company. And the difference between a public company and a private company is a public company is on the stock exchange, okay? And so the rules are very, very strict for a public company about how they do things and how they disclose things. They're in the public spotlight, and different US authorities have very strict rules for them. So in the instance of a publicly traded company, like the publicly traded company that I work with, we're regulated by a branch of the US government called the SEC, the Securities and Exchange Commission. And it was founded back in the 30s. You don't have to remember this, but round about the 30s, it was founded to regulate financial markets. And one of the goals of the SEC was to systematize and standardize financial information. In other words, so you can have apples to apples. Back in the day, before the SEC, financial information was kind of the Wild West. It was, apples to bananas, cucumbers to oranges, and it was hard if you had, for example, let's call it 100 years ago, 4 railroad companies. One railroad company saying that they had $100 in profits, the next $100 in profits, the next $100 in profits. Under the old rules, it looked like they were all doing the same. But once they standardized things, they would find out that under the old regulated days, companies were doing things differently. It could sometimes result in what was perceived to be the same financial results, but in fact were different. So the SEC has a very, very strict series of rules that govern accounting information. And there are regulatory bodies that regulate that accounting information. And we'll go into further details on that. So I wanted to start with looking at financial statements. Now, why are financial statements important? Well, one, they tell the story of what a company did. That's to say, how much revenue it earned, how much money it made after taking into consideration all the expenses, the income. It talks about, financial statements talk about what a company has. So we call it balance sheet. It's what a company has, how much cash, how much assets, how much debt, liabilities. Debt is, think about debt. You have a credit card bill you didn't pay, that's debt. It's called a liability, right? We're gonna get into that. So financial statements basically indicate how a company's doing or how it did. It's always kind of rear view mirror looking, and then what a company has. It also says a lot more, but generally, if you want to think about financial statements and why they're important, the financial statements say how the company is doing in terms of its revenues and its profitability, and what a company has in terms of its assets and its liabilities. That's important stuff to know, right? It's important stuff to know, because how are you going to know how much you're going to pay for Zoom? Oh, you want to pay $32 billion for Zoom. Why? Okay, their share price is at $108 today. It was at $550 2 years ago. Why? Well, the why, it's complicated, but a good start for an answer on why a company is valued at where it currently is because investors are evaluating periodic financial information from the financial statements. Okay, I mentioned the financial statements. Let's get to them. So let me share the screen again. Okay. This is kind of annoying because the screen share mode kind of blocks in my browser. So I'm going to get over this. Bear with me for a second. I'm going to find the website I want. Then, okay, here we go. Now, you might remember that I mentioned the Securities and Exchange Commission, the SEC. Well, here we are. We're at sec.gov, and we are at this. So it's this government organization called the SEC. They have a lot of power. They have a lot of authority. They enforce all the financial rules for publicly traded companies in the United States. The publicly traded companies issue their financial statements on two primary forms. Again, you don't have to remember the details of what these forms are called, but I'll mention it to you because they'd be good to kind of know. The annual form that companies use to basically give their huge book report that they do once a year is called a 10K, okay? And then every quarter, every 3 months, companies put out a 10Q, which is a much smaller book report that has more abbreviated financial information. And again, the financial information that is in these forms 10K, forms 10K and 10Q are called financial statements. Boy, I've been mentioning financial statements. Let's finally get to one. I'm going to open up a small book report, a little bit less overwhelming. So I'm at this SEC website, right? Let's go back for a second. Get to this SEC website, and I type in, I've already mentioned the ticker symbol, okay? Now, what's the ticker symbol? The ticker symbol is the series of letters. It's different for every company. Remember, we already looked up the Zoom over here. Remember Zoom? And their ticker symbol is ZM. Okay. Now we're going to go back to Edgar. Golly, Bob. Okay. So we went to the SEC website, and we're going to enter in the ticker symbol of Patrick, right? Okay, I'm going to do search. Not a good day for me. Here we go. Let's try again. Okay. This is a 10Q. So this is one of the small book reports that Patrick puts out. Okay. Patrick's a publicly traded company, right? And we talked about their market capitalization, how much you'd pay for them. Now Yahoo has got information that says 1.6 billion. I think that their calc's a little bit off, but don't quote me on it. But theoretically, let's say that was the case, right? So people want to pay $1.6 billion for Patrick. Okay, at least that's what Yahoo Finance would indicate, and their stock price is trading at about $70. Well, why? Well, so our thesis is that investors are evaluating financial information and they're looking at financial statements. Okay. So what about those? Okay. Here we go. So this is a financial statement that it's for the third quarter, and it's September 26, 2021. The financial statements are organized into the following categories. You begin, and we're going to go back to these. I'm going to speed through it first, okay? And I'm going to go back to it. We're going to talk to it, okay? We're going to talk about what this stuff is, okay? Your income statement. Your statement of comprehensive income. That's one we're not going to cover. It's not that important. But your income statement is your most important, in my opinion, or at least top category for being a candidate of most important. Your balance sheet. Your statement of cash flow. Your statement of shareholder equity, that's like the statement of comprehensive income. I'm kind of skip it. It's not that important. It's not that important. Okay. Your income statement. Now, some people would tell you that your income statement is not the most important financial statement. Some people would maybe say it's cash flow. It depends. There's a good debate, but let's talk about what the income statement is, and I'll leave it up to you to determine whether you think it is or is not the most important financial statement. Okay, and again, the purpose of the financial statements, again, the purpose of the financial statements is to make decisions about a company. Now, candidly, financial statements allow, if we work at the company, it allows us to make decisions about the company based on what we think the company should be doing and where the company should be going. It might influence our decisions about how we make investments, right? Let's say we have a bunch of plants. How should we make investment decisions about equipment we buy for those plants or resources we should allocate to those plants? Well, maybe we're going to look at how profitable those plants are, right? Or if we need to make some changes, maybe if a plant isn't being very profitable, what are we looking at? Looking at the financial statements. Okay, we'll go back to the financial statements. I'm going to share again. Okay, the income statement. It begins with your sales, or what is also called revenue. And sales, what is sales? What is revenue? Well, that is the money or consideration we or you or all of us receive when we sell something, right? So if you go to Portillo's and you buy a hamburger, and you fork over $10, they've just recorded $10 in sales, okay? Cost of goods sold. Okay, so cost of goods sold. What's going on there? Well, you went to Portillo's and you forked over $10 for a hamburger. Maybe it was a double cheeseburger with bacon and with a lettuce wrap, which is how I get it. Okay, maybe with some fries and a cheese sauce and a Diet Coke, something good like that. Getting kind of hungry thinking about it. Cost of goods sold. Let's say it costs Portillo's $5 to buy all that stuff and to bring it all together to give you that delicious bacon double cheeseburger with the lettuce wrap. Okay, their cost. So if they're selling it for $10, but it costs them $5 of product, their cost of goods sold is $5. Okay, so that's what cost of goods sold is. It's your materials, it's your inventory, it's the cost of all that stuff, and then it's also the cost of the labor. If you're making things, right? Let's say you're making recreational vehicles. I don't know if you've ever heard of those. They make a few of them in Elkhart. Let's say you're making recreational vehicles. Well, if you're Thor, right? You're selling recreational vehicles. Your cost of goods sold is going to be all those materials that go in to make that RV. You know, your panels, the membrane on the roof, and the chassis, and all the sealants, and the membranes, and the microwave inside, and the shower, and the cabinets, and then the labor, right? The labor. All those folks that are building the RVs and working around the clock almost, as it seems. The labor is going to go into the cost of goods sold as well. Another thing that's going to go into the cost of goods sold is what you call overhead. And what's that? Well, you have to pay, electricity and heat and all kinds of good stuff to keep that plant running. And that's something that's also allocated to cost of goods sold. So Portillo's, their cost of goods sold is the folks that are cooking the burgers for you, and their hourly wages, right? And then Portillo's has to keep the lights on. You wouldn't want to go into the building if there weren't lights on, so it has to pay electricity bills for that, and so it's going to allocate some of that electricity bill and to its cost of goods sold, and that gets in there. And they mop up the floors, and mops wear out, and use cleaning solution. All that stuff goes in cost of goods sold as well. Now, that gets us to gross profit. And gross profit as a percentage of revenue. So if we took that 208 million and we divided it by 1,060,000,000, and then we made that into a percentage, that would be what we would call gross margin. And that's one important way that investors measure profitability. What's a profit, by the way? What's a profit? Measure profitability. What does that mean? Well, a profit is sales less expense, right? There's different kinds of expenses. This income statement has some types of expenses that wouldn't be present on everybody's income statement. We don't need to get into all of the details, but when we're looking at gross profit, however, you're going to see most companies out there in corporate America have your sales and your cost of goods sold, and you're going to have gross profit. Okay, so in that way, you can compare Portillo's to Patrick, at least as it relates to gross profit. We've got some other line items that are going to get us to operating income, and we'll talk about what operating income is. We've got warehouse and delivery, right? So in the instance of Patrick, that's going to be your what you're paying for your warehouses and what you're paying to ship your goods. You're selling, general, and administrative. So your corporate folks, your sales folks, your people that are working in accounts payable and accounts receivable and treasury and financial planning and analysis, and all of your accountants and your corporate accountants and your controllers and your divisional controllers and your environmental health and safety people and your human resources people, all those people aren't showing up as volunteers. No, in fact, they're showing up for salaries. And so selling, general, and administrative, at least in the case of Patrick, would cover those types of things. It's kind of a weird thing below that. Amortization of intangible assets. We can cover that at a maybe a breakout session, but that's kind of an accounting. That's kind of an accounting convention that is very, very company specific. And it's just one of the things that you'll see in the income statements of some companies. You'll see something unique. But in general, an intangible asset is something that occurs when you buy another company. So Patrick is very acquisitive. And so when they buy companies, intangible assets are created. And the way that the expense for that intangible asset is subsequently recorded in the income statement is through amortization of intangible assets. But that's, again, it's kind of technical, fairly specific thing that we're not going to get into. But when we take our revenue less our cost of goods sold, less our selling, general, and administrative costs, some other costs, we get to what that's called operating income. Okay, operating income. Right there it says 93 million. Below that, interest expense. Now, would all companies have interest expense? No, only companies with debt. And we're going to get into what debt is, but long story short on debt, if you've ever used a credit card and you haven't paid your bill yet, that's kind of a liability. It's a liability and it's debt. It's an IOU. It's something you owe. So for companies that have debt, they're borrowing money and they're paying interest on the money they borrow. And the interest on the money they borrow is called interest expense. So 93 million bucks of operating income, 15.4 of interest expense, and now you get income before income taxes. Okay. Then you have $20 million of income taxes. Now, income taxes, I think we all are familiar with income taxes. I mean, we get them, as individuals, we get them taken out of our paycheck, and with corporations, they file these tax returns and they've got to pay Uncle Sam like all of us do. Okay. And that brings us to net income. Net income is, at the end of the day, after all is said and done, how much money did we make? That's net income, right? That's net income. Now, the next thing we have is net income per common share. Now, what is that? Boy, well, we talked about when we were at Yahoo Finance, we were talking about market cap, right? And we were talking about market cap for Zoom. I think it was ZM, right? Yeah. And we said, okay, Zoom is worth $32 billion. Okay, oh boy, now how do we get to that number? Well, we took 108.94 and we multiplied it by the shares outstanding, or we didn't, but Yahoo Finance did it for us. We got to 32.6 billion. Well, when investors are evaluating the profitability of a company, how much money a company made, they're looking at various measures, but among them, they're looking at net income, but they're also looking at net income divided by how many shares are outstanding. Net income divided by how many shares outstanding is called earnings per share. So you're gonna, if you keep following Yahoo Finance, you keep reading your Wall Street Journal, and you keep logging into some other websites that we're gonna go to. We're gonna go to Seeking Alpha. I'm going to go to Alpha Sense later on today. I'm going to show you some cool websites that I look at. But you're gonna see in a lot of these press releases and articles in the Wall Street Journal, EPS. Zoom releases EPS of, I'm gonna make this up, $7.32 per share, beating analyst estimates. Okay, EPS, earnings per share. Okay, well, what is that? Well, it's one way that the investors look at companies and measure their profitability, and that metric is obtained by taking your net income. See, we got, in this instance, we've got 53,397,000. We divide that by 22,789,000 shares. We get earnings per share of $2.52. So I could do that in Excel real quick just to show you kind of like what I'm getting at there. So if I go into Excel, I'm going to swap my browser to the left side, and I'm going to bring my Excel to the right side so we can do this real time. I got my Excel, and we were just looking at the Patrick income statement, and I said there's 57,397,000. I had that right. Oops, too many zeros. Few zeros. 57,397,000. Okay. And then there are 22,789,123 shares outstanding. Now, where am I getting my numbers from? Right here, 59,397,000. And then that's how many shares. Now, what's a share again? A share is represents an ownership of the company. So if you owned all 22,789,000 shares, you'd own the whole company. And if you owned half of that, let's see how good my math is. If you owned half of that, half as many shares, right? You'd own 11,399,000 shares. Okay, EPS, let's get back to it. EPS is net income of 57,397,000 divided by shares outstanding. It gives us $2.52 of EPS, or earnings per share. And so I just did that on Excel, but you can also see right here that $2.52 matches up with what we just did in Excel. That's kind of nice. EPS. And so EPS, let's get back to Patrick. Here on Yahoo Finance, they've got predictions and expectations on what EPS is going to be. Now think of it like, what do you think that, what do analysts in football or in basketball or in hockey or in baseball think that the score is going to be? What's the over under, right? So these analysts, you've got these stock analysts, and they're no different than like your ESP analysts or, your movie reviewers. They're following the company, and they're looking at the financial data, and they're making estimates and expectations about how much a company is going to earn. And what they think things are going to be. And so I just clicked here and went to analysis on Yahoo Finance, and it says that Patrick has got 4 analysts. He's got 4 different folks that work in banking institutions, and they've got estimates of EPS. Look, estimates. And remember, what was EPS? EPS was when we, if somebody has some technique to help me navigate my browser while doing Zoom at the same time, I would be in such gratitude. Okay, so what is EPS again? EPS was net income divided by shares. That got us EPS. And we did that in Excel. We calculated EPS ourselves by taking revenue divided by, or net income divided by shares. And going back to Yahoo Finance, looks like these analysts have got high and low estimates of EPS for the quarter and then for the year. They've got high and low estimates of revenue. Now, revenue, look at, they're also using the term sales. Revenue and sales, they're one and the same thing. There's no difference between revenue and sales. They're just two different phrases. So if you want to use the word revenue and you want to use the word sales, it's the same thing. Now, these analysts are kind of predicting EPS, they're kind of predicting revenue, right? They might not get it right. They're also suggesting values of the companies. They'll have share price targets. And those share price targets, the analysts are looking at, they're looking at the financial information. They're looking at the financial information. They're looking at the financial statements. We're going to get to more of the financial statements. I'm focusing on the income statement and I'm trying to triangulate it back to real world stuff. You know, like, look, we have this textbook. It's not a bad textbook. We'll get some use out of it. But I'm doing this stuff like in the real world, real time, doing it for a long time, right? And my team puts together financial statements that, like, the very ones that we're looking at right now. So I know what goes into them. And I work with the analysts, right? And I work with the buy side, the folks that are buying our stock, talk to them. There are things I can and cannot say to them, talking to the analysts and sharing my thought process with them, and they're sharing their thought process with me. But we're looking, we can't have a conversation about results, how we're doing and what we have and what our stock could and could not be worth, unless we've got intel. Okay, that's the financial statements. Maybe they look boring at first, but they tell a story, and then that story is not boring. What organizations do, what Zoom sells, what Patrick sells, all the incredible things that are synergistically creating the products, the development, all the hustle, all the story behind it is told at the end of the day in the financial statements. And so while the financial statements and all the accounting behind it can be dry at first, if you start by unpacking the story behind it, well, how did these guys do? All the people are doing it. The financial statements don't exist without the people. You have the people that make the products, and they have the customers, and they have the sales, and they have the profitability, and then they have their future and their past and expectations. I mean, that itself is very exciting. So learn to love the financial statements because they tell the story, even though, you know, I don't know if anybody had a dream as a child of like being an accountant. It's typically like astronaut, or actually, I think with this generation, it's like YouTube star. My generation, it was astronaut. I ended up getting down the accounting and finance route. I'm a licensed CPA. I have no idea how that ended up happening to me. And I'm principal accounting officer and vice president of finance. But in any case, I'm excited about financial statements, unless you can't tell. I'm going to go back to Yahoo. Come on, share screen. There we go. So they've got the analysts following earnings history, right? EPS trends, how they've been doing. You see, the analysts are following EPS. EPS is a very, very simple way to follow success or failure, because, you know, if we go, we go back to this income statement, all this stuff's kind of going on right now, okay? And for those of you who have never seen an income statement before, you're probably saying, God, what is all that stuff? Third quarter ended. They got what, 2021, they've got 2020, they've got all these lines. Jim was talking about all these different things, net sales, gross profit. That's too much. Okay, maybe get it. It's a lot. I've never seen this stuff before. It's a lot. I feel you. But EPS is just one little, it's $2.52, right? So it's something that analysts follow because they can't predict, okay, I think revenue is going to be this, and cost of goods sold is this, operating income is going to be this, and interest expense is going to be this, and taxes are going to be this, and then it's a lot of moving pieces. EPS is one metric. It's probably the most standard metric. We'll talk about some other metrics such as EBITDA later on, which is earnings before interest, taxes, depreciation, and amortization. But EPS is it's kind of neat and clean and all wrapped up in one box. It's expressed in dollars. $2.18. They're going to earn $2.18 per share this quarter. That's what they say. Just an example, right? And so EPS it's a relevant metric. It's something people talk about, and you can see that it's here on this income statement. We're going to skip comprehensive income. That's an advanced accounting class that I would teach. Not that I would love to teach it, but I could teach it. Balance sheet. So we just did the income statement. This is the balance sheet. What's a balance sheet? Balance sheet is what you have. It's what you have. You have two types of things in your balance sheet, two types of main categories of what you have, okay? You have your assets. Those are productive things. Okay, you can do things with them. They will generate revenue. They will generate profitability. So for Portillo's, the building that it owns, the burgers it has in the fridge, the slices of cheese, the soda fountain. Those are its productive assets. Okay. Cash it has in the bank. So here, is Portillo's a publicly traded company? It is. How cool is that? And their market cap, it says, is $827 million. So their share price is 23. And then if you knew how many shares they had outstanding, you'd get a market cap. So if you wanted to buy Portillo's today, it would cost you $827 million. It's kind of neat. You know what? I'm interested now in Portillo's. What was the ticker symbol on Portillo's? Anybody remember? What does it say? PTLO. PTLO. Okay, let's go to the SEC website. Now we don't have to go to the SEC website for these income statements, by the way. There's a couple of other places we can go. There's a lot of places we can go, but we're just going to stick with this Securities and Exchange Commission, even though it's kind of boring. So PTLO, let's type that in. It's kind of neat. I haven't ever really looked at their financial statements before. So this is at 10Q. So remember, there's two types of book reports. 10Q, the short one, happens 3 times a year, and then the 10K happens at year end. That's the big book report. Portillo's, there we go. Look at financial statements. Again, I'm flying. Okay, here we go. The income statement, sometimes called statement of operations. So remember, there are different phrases that mean the same thing. Remember, we talked about revenue and sales. They mean the same thing. Income statement, statement of operations, same thing. Don't worry about it. I just remember the term income statement. And what is an income statement? Again, an income statement is what has happened. How much did you sell? How much did it cost? How much did you make in the end? What were your profit? What were your profits? EPS, earnings per share. What's that again? Net income divided by the shares. What are shares? Shares are ownership stakes in a company. If you owned all the shares of a company, you will have owned that company. Okay. So Portillo's, right now, it looks like they, in a quarter for in a 3-month period, and this is one ending in September of 2021. Portillo's is, as I'm reading it right now, it's 138 million in top line revenue and sales, right? And looks like it has their cost of goods sold. And they've got they break it out. So remember, see, they break it out a little bit differently than Patrick did. They've got labor, they've got occupancy and other operating, right? They got their general and administrative expenses. Again, we talked about how those would be just your corporate expenses, your folks in accounts payable and AR and treasury and financial planning and analysis and all your accountants and all that good stuff. 11 million. Net income at the end of the day of 6.5 million. You got a little bit of interesting accounting going on here. We won't get into this, but it looks like they've got some share unit structure where some of the owners of their stock take away some of the money that they made, and so it doesn't leave them with a whole lot of money at the end. Looks like this period year to date is doing a little bit better than this quarter. This quarter is a little bit tough for them, but in any case, that $645,000 divided by their shares down here gives an EPS of 1 penny. So anyway, Portillo's is they just went public. They just became a company you can trade in the stock exchange. And so what you see sometimes with these high growth companies is that they've got a lot of expenses up front in the first few years, and they're not very profitable because they're growing so much. When they eventually settle in, the profitability comes back. Let me go back to Patrick. We're going to talk about the balance sheet. The balance sheet is what you have, okay? And we're going to go to this 10Q. There's 10Ks and 10Qs. 10Ks are the big ones, right? 10Qs are the small ones. They happen 3 times a year, every quarter. And then at year end, you have a 10K. And that's a really, really big book report where the company, according to the rules of the Securities and Exchange Commission, they put out the financial statements and they put out a lot of other information. We're going to go through that as well. So the assets. So let's just take Patrick for example. Okay. Cash and cash equivalents. Self-explanatory. Cash in the bank, right? What are cash equivalents? Well, you might have, let's say a company would have your basic checking and savings account, but it also might park some of that cash into what you call short-term investments, short-term securities that mature in a very short period of time. If you've ever had a CD in your bank account, it's kind of what that is, but it's something that's basically cash because you can turn it into cash and buy something with it in a matter of days. Trade and other receivables. So when I sell something and someone hasn't paid me yet for that thing, that is what you call accounts receivable. So if I sold you a bunch of cabinets, right? You're a big manufacturer at an RV, and I just sold you $1 million of cabinets, and you can go put them in your RVs, and very nice cabinets, give a lot of nice space for your plates and your food and storage. You're going to pay me, let's say, a month from now, right? Because I give you the stuff and you get the invoice, and then eventually your accounts payable people get around to paying. And so for me, I'm waiting for that money. And that's what you call accounts receivable. And here, that's called trade and other receivables. Okay. Again, what is a balance sheet? It's what you have. Okay. What is an income statement? What is an income statement? Income statement is what happened, how much you sold, how much it cost, how much you made in the end. Okay. You divide that by the shares, and what are shares? It's ownership interest in the company. You get EPS. And why is EPS relevant? Because analysts follow it. It's very, very commonly followed. And stock analysts are no different than ESPN analysts. And they're saying, okay, the Bears are going to do this, the Cubs are going to do this. I grew up a Bears and Cubs fan. I grew up in Chicago area. Okay. Inventories. What are inventories? Well, inventories are the goods that you have right now that you're soon going to sell. Okay. So let's say I have a bunch of cabinets in a warehouse that I'm going to sell down the street to an RV manufacturer, right? Or I've got rolls of rubber membrane that I'm going to put on the top of an RV roof, or I've got a bunch of thermoplastic molding shutters that I'm going to sell to a manufactured housing company, right? That can make a manufactured home. Or I've got vats of adhesive resin or something like that, right? I've got big bundles of fiberglass. I've got pallets of Luan fiberboard. That's my inventory, right? And once I get done describing what prepaid expenses and other are, we're going to talk about what all those current assets are and what that means. So let's go back to share. Okay. We're about 56 minutes right now. We're going to aim for 2 hours and 40 minutes. God, can you imagine, guys, that I'm going to talk about financial statements for 2 hours and 40 minutes? As you get to know me better, won't surprise you. I'm kind of famous, not that famous. I'm kind of famous for, if you ask me what time it is, I'll tell you how to make a watch. I'm curious. I mean, some of my educational experiences, let's talk about my educational experiences. I went to IU. I went to IU Bloomington. I'm doing the same thing you guys are doing right now. I did my undergraduate in like this, philosophy and economics. And I know you're probably rolling your eyes about the philosophy. When I was a teenager, like let's say 18, 19, 20, I thought I was going to go to get my PhD in philosophy and become a professor. Other things intervened. I picked up an economics degree at IU. So I was IU Bloomington. I loved it. I loved it there. I had incredible professors and I learned a lot. I think in high school though, I didn't really have a very good educational experience in high school. The first smart people I ever really met in my life that were teachers were at IU. It was the college professors. They were totally different than the high school teachers. And the high school teachers, they said stuff, but they didn't have any like real intellectual curiosity and like what was the thought process? Why? I was always asking that, and they were always frustrated with me. Why are you just? I said what I said. It is what it is, and that's of course not true. Just when you say something, then it opens up all kinds of observations, and then there's the why, and you break it down, and that's all that intellectual curiosity is the whole point of going to school. And so for me, coming from Northbrook, Illinois, I went to Glenbrook North High School. I landed at IU, and these professors were incredible. They were so smart, they were so detail oriented, they were so enthusiastic, and they really pushed the students. And so that's why when I'm looking at this stuff, I like this textbook, it's great, but I also like looking at the real world stuff and then really, really talking about it, because that's going to be, as you go in and you enter the corporate world or the business world, the textbook is great. And knowing these concepts and knowing these fundamentals is essential. But the devil's in the details. So that's why I like to talk about these details and these real world situations. Go back to the balance sheet. I'm going to be a bit of a broken record, but I think repetition leads to perfection. Okay, so what is the balance sheet? Okay, the balance sheet is what you have. What is the income statement? The income statement is what happened, what activity happened. What were your sales or revenue? Remember, sales and revenue, they mean the same thing. What were your expenses? What was your resulting profit or income? Okay, what was your income? What was your EPS? What is EPS? It's your net income divided by your shares. What are your shares? Shares are ownership interests in the stock, right? Like in Yahoo Finance, there's the share price of the stock. You want to buy one share of Portillo's, you're going to shell out $23.11, right? You want to buy all of Portillo's, it's all the shares outstanding. Each one represents ownership in Portillo's. You multiply $23.11 by all the shares outstanding. What do you, 827 million. See that right there, market cap. Market cap is another phrase for how much the whole company would cost or how much it's worth. And how on earth does anybody ever figure out what Portillo's is worth or Patrick is worth? So financial information, financial statements, where do you get that from? Well, in the case of the publicly traded companies, what is a publicly traded company? It trades on the stock market, and this is what I'm talking about. This ticker symbol, PTLO, remember Zoom was ZM, Patrick is PATK. The share price, how does that even get figured out? Whose job is it to do that? Well, all the people buying, selling the stock. And how are they making decisions on that? Well, they're looking at the profitability, they're looking at the revenue, and then they're also looking at what the company has. That's the balance sheet. Okay, prepaid expense is another. That's the last thing. Prepaid expense is another. Let's say you sign up with a janitorial service and they're going to clean your office, right? Okay. And you sign this really great agreement with them for two reasons. One, you want to lock in like a killer price. You know, it would typically cost like $500 a month to get cleaning, but they're going to sell it to you for $100. And why? Well, you're going to sign a 3-year contract, and not only that, you're going to pay upfront. You pay it all up front. That would be an example of prepaid expense, and it's something that you paid for now, but you haven't gotten the benefit. You know, so they haven't cleaned the benefit. What does it mean? You haven't gotten the benefit. You haven't gotten the cleaning service yet. So if you paid $100 for cleaning services, and you're going to get those cleaning services over a year, you're going to record it as an asset. Now that is an accounting concept called an accrual. What does that mean? Accrual. Accrual. No, we're gonna do a real world test. We're gonna see if Jim actually can do a definition real time. So an accrual is the recording of an asset or a liability which represents a future benefit or expense in the future, right? So unlike cash basis, so let's go to Investopedia. Investopedia, great website. Let's accrual accounting, right? Do they have anything on accrual accounting? Here we go. Accrual accounting is a financial accounting method that allows a company to record revenue before receiving payment for goods and services sold. Okay, this is terrible. This is terrible. That's just patent. Accrual accounting, because you can't recognize revenue before before you've actually earned the ability to record that revenue. That was a terrible definition. What they should have done is they should have said it is the recording of an asset when cash has been paid, or when a benefit has been incurred, or the recording of a liability when an expense has been incurred, or when goods or services, or when consideration or cash has been received without that company having performed that service. Okay. Accrual accounting. Accrual accounting versus what? Accrual accounting versus cash-based accounting. So let's say you're using QuickBooks and you have a burger stand, and you got $100 in the door today. You had $50 in bills that you paid, and you're going to say, okay, profitability at the end of the day of $50. Under the accounting rules, I'll throw out another acronym, don't get overwhelmed. Under GAAP, generally accepted accounting principles, and those are that's the rule book set for accounting that allows the accountants to come up with all these numbers and terms. We don't record our results on the balance sheet or on the income statement based on cash in and out, but by what happened. Now, okay, that's a little bit confusing, but not really, because let's look at some of the things that we already talked about today. Cash and cash equivalents, okay. There's no accrual accounting for cash and cash equivalents, but what about trade and other receivables? Well, we already talked about accounts receivable. So I sold $1 million worth of cabinets to the RV company down the street. They won't pay me for 30 days, but there's the accrual accounting operates in two things. Okay, now maybe Investopedia's definition wasn't so bad. I just got a little bit angry. I recorded, I'm going to record $1 million of revenue. I haven't received the cash yet, but I can still record the revenue. They'll pay me a month from now, but I recorded revenue. And then the other, so that's an accrual. That's a concept of the accrual. The event happens, so you put it on the accounting books and records, but you haven't received the cash. The other accrual is I also recorded $1 million of accounts receivable. What's accounts receivable? Well, it's you perform the service. I've given $1 million worth of cabinets down to the RV company down the street, but they haven't paid me yet, so I have accounts receivable. All these things together, the cash, the trade and other receivables, the inventories, the prepaid expenses and others, those are current assets, okay? Current assets are your assets. And what are assets? Things that you have, okay, that are going to be translated into cash in a short-term period, okay? Those are your current assets in 12 months or less. Long-term assets, these guys right here, these are assets that are not going to be translated into cash in 1 year. They're long-term assets. And in this instance, we're just going to focus on one long-term asset, because the other ones are going to require a little bit more of a technical accounting discussion. And while I would love to have a technical accounting discussion about this balance sheet, I don't think anybody's going to stay awake for it. But hey, listen, in office hours, you want to talk about any of these accounting balance sheet line items, more than happy to go into detail. More than happy to go into detail. Property, plant, equipment, that is the machinery that makes the stuff that makes your products. So it's with this property, plant, and equipment, and it says that there's 309 million of it. That's the stuff that makes your inventory. And inventory looks like it's at 485 million, right? Cash is at 44 million. Okay. That's the stuff that you have. Now, then there's also the stuff that you owe, okay? When you owe something to someone else, whether it's another company or whether it's a bank, right? You have what you call a liability. When you own something and you have an economic right to something and it's going to generate cash for you, that's an asset. See your total assets. Go to Yahoo Finance, they have financial statements as well. Look at revenue, EPS, there's your income statement. Where's your balance sheet? Look at this balance sheet. Total assets, total liabilities. So Portillo's has got total assets of 910 million. They've got liabilities of 769 million. So when you owe somebody something for a variety of reasons, you've got a liability. But when you have something, you have an asset. Okay, an asset is something you have. A liability is something you're eventually going to have to give up an asset to pay back, right? So if I have this debt right here, looks like current maturities of long-term debt. Got accrued liabilities. I've got accounts payable. This is all 219 million of accounts payable, 145 million. I'm going to have to eventually use some of this cash up here to pay this stuff back, or take cash that I'm generating. We'll talk about the cash flow statement below. But a liability is going to require you to pay back something to someone. Okay. And your main types of liabilities are broken out into just like we had current assets, short-term assets, and long-term assets on the asset side of the balance sheet. Just as we had the current assets with the short-term, which are the short-term assets, we've got liabilities. Now, again, what's a liability? Something that we owe. So let's say your friend lent you some money, you owe them $20. Okay, that's a liability for you. And they want that paid in 10 months. So that's a short-term liability. You have to pay it within 1 year. Okay. If your friend said, I'm gonna lend you $20, you have to pay it back in 2 years, that's a long-term liability. Okay. And then if he or she said, hey, I want you to pay me interest, once you pay 5% interest, that's going to be your interest expense. Okay. Where do we see interest expense? Where do we see interest expense? When we were talking about the income statement up here, we saw interest expense. Right here, interest expense, $15 million. Does Portillo's have any interest expense? Well, we'd have to go to the income statement to see, so we have to go to the income statement. The Yahoo Finance doesn't have very detailed information on Portillo. So maybe I'll go to Portillo's financial statements at the FCC website. Okay, so it had $138 million of revenue for this quarter. Cost of goods sold of $44 million. Labor, occupancy, other operating expenses. So it had occupancy expense of $103 million. Interest expense, there we go. That means that Portillo's has some debt. That's an example of a liability. Let's go to their balance sheet. Here's their balance sheet. Again, I'm flying blind. Okay, here we go. Here's the balance sheet. Okay, assets. We have our current assets. We have our long-term assets. What are assets? Things you have. Economic benefits come from those assets. And then liabilities are things that you owe and you're going to have to pay back eventually. Accounts payable. Portillo's. Accounts payable. Patrick, 219 million. Portillo's. Accounts payable, 21 million. What's an accounts payable? Well, remember when I gave the example of the $1 million of cabinets sold to the RV company? They hadn't paid yet. They're going to pay in 30 days. They have 30-day terms. So that was an asset for us, accounts receivable. But on if you flip it on its side, so now I went to a vendor and I bought $1 million worth of these 100-gallon drums of adhesives, okay, or chemicals, or I bought bags of dry resin that I'm going to melt into membranes that are going to be these big sheets that we're going to sell to an RV company. Or I bought thousands of pallets of Luan, which is this thin, lightweight plywood, right? You use it to make paneling, right? Or I bought a bunch of aluminum that I'm going to bend and make components for an RV, right? Well, I'm going to get that stuff, right? It's going to arrive in my warehouse. It's going to become an inventory, but then I owe them the $1 million for all that stuff that I bought. That's called accounts payable, and it's a liability. I'm going to have to give up assets to satisfy that liability. What does that mean, to satisfy that liability? Well, if I owe you $1 million, okay, now I have the bill, I have the invoice, and the invoice says you must pay within 30 days. Well, when I finally go to my accounts payable department and they actually wire the money or cut the check or whatever they do, it's electronic these days mostly. That liability, which is I have to pay them $1 million, was satisfied by the cash that I had in the bank account. So I wired that money out and I satisfied the liability, meaning that the liability went away. But until I do that, I have a liability, and that liability in this instance of when I'm buying stuff, but I haven't paid for it yet, it's called accounts payable. It's called accounts payable. And right now, Portillo's has got accounts payable of $21 million. I can imagine, I haven't read the footnotes to the financial statement, I haven't read the narrative, and I haven't met with their management, but here's a good guess. A lot of that is for French fries and burgers and buns and cheese and ketchup and Coca-Cola and probably outfits that they give to their employees. Okay. Accrued expenses. Portillo's has got accrued expenses of 33 million. Here's a guess. I haven't gone to the footnotes. The footnotes, the financial statements, we're not going to get into them. These are descriptions of the income statement and the balance sheet. It's a smaller book report. But if I was gonna guess, if I was a guessing person, of what that $33 million is of accrued expenses, there's a big portion of that that's probably payroll, right? So if they issue their financial statements and their folks have done, let's say, a week of work, all of them all together, but they haven't been paid yet. The accrual concept is if their folks have done, $33 million of work over 1 week, but payroll is not until another week, they don't get paid. Let's say they get paid every 2 weeks. Then they would have accrued or incurred a liability of $33 million. Now, if you go to Patrick, their accounts payable is $219 million, and that's for all the stuff they buy they haven't paid for yet. And then accrued liabilities are going to have payroll in there, right? And why would you accrue for payroll? Well, same reason that we would accrue for accounts receivable. I sold $1 million worth of stuff. They're going to pay for it. So I've got receivables up here. Remember the assets. Assets are what you have. Liabilities are what you owe. Trade and other receivables. That's $292 million. It means I sold $292 million worth of stuff, and then sales or revenues up here. I sold that stuff. I just haven't received cash for it. Same thing with accrued expenses. If I've got payroll, accrued liabilities, $145 million. I've got payroll. That's the department that pays people, right? They send people to paychecks. Let's say I've got a week's worth of wages. Now, we don't give the checks to the employees until another week out, but they've already worked for a week. And so we owe them. We owe them. So we accrue for it. It's not a cash basis. Okay. We accrue for it. Accrual accounting is when you record an asset or a liability before cash has been received. Okay. Okay. So this is the short-term liabilities right here. Okay. This I've got to pay within a year. It's $7.5 million of debt, some leases, accounts payable, and accrued liabilities. What's accounts payable? It's also called AP. Accounts receivable, also called AR. AR is stuff that I've sold, I haven't received the cash for it. AP is stuff that I bought, I haven't paid the cash for it. Asset, accounts receivable, liability, accounts payable. Long-term liabilities. Well, those are liabilities. Those are things I'm going to have to pay a year or more from now. And the main category here is debt. What is debt? Debt is when you borrow money and you pay interest on it, generally over time. And then when the debt is due, okay, remember you had a friend who lent you $20. Okay, in one instance, your friend said, pay me back in 10 months. In the next instance, the friend said, pay me back in 2 years. Okay, debt's the same thing. In this case, this is $1 billion worth of debt. and it has different maturities. Maturities mean when you have to pay it back. And if you have to pay it back in a year or more, it's called a long-term debt, okay? And that's a liability, and it's a long-term liability. There's some other liabilities here related to leases and taxes, but I don't think we want to go too much into that. One of the key things about a balance sheet, and again, what is a balance sheet? It's what you have and what you owe, your assets and your liabilities, right? You think about it, you know, the income statement is basically, if you go up here, the income statement is, the income statement's what happened, and then the balance sheet is, okay, you say, pause, timeout, right? At this date, pause, timeout at this date. What do we have and what do we owe, right? Right, so the income statement is like the game, right? And you kind of have the score. Balance sheet is kind of when you put the pause button. So the income statement was, okay, we had all these sales and all these days went by and we sold all the stuff and all these expenses and all this stuff was incurred. And then the end of the period, we've got our profitability, right? Our net income, our EPS, which is net income divided by shares. What are shares? Shares are ownership stakes in a company, right? EPS, net income divided by the shares. EPS is talked about by the analysts. It's a quick number, $1.22 of EPS. It's kind of easy to talk about instead of all these income statement lines. Everybody's got a different income statement. Portillo's has a different income statement than Patrick. Patrick got a different income statement than Zoom. Why? Well, because they do different things. Zoom's a software company. Portillo's is a hamburger company. Patrick supplies the RV and marine market, right? And MH and industrial. So while they're generally similar, like you always have revenue, you always have expense, you're gonna have your gross profit. You're always gonna have net income. You're always gonna have EPS. And your balance sheet, everybody's gonna have cash if they have it, right? They're gonna have some type of asset. They're gonna have some type of liability. But most likely, they're always gonna have, if they have sales, they're gonna have accounts receivable. They're gonna have accounts payable. One's an asset, one's a liability. And if they borrow, they're all going to have debt. And that's going to be short-term and long-term. Short-term means something you have to pay back within 12 months in a year, right? Long-term is more than a year. Let's get back. So your assets and liabilities. There's a balance in a relationship. It's called the balance sheet. Why is it called the balance sheet? Because it balances. What balances? Okay, let's get back to the balance sheet. Let's talk about why it's called a balance sheet and why it balances and what balances, right? Okay. There we go. See, did you ever think financial statements could be so exciting? I'm just beginning to get all revved and do stuff. God, whew. Let's go balance sheet. Okay. Your total assets, $2,358,000,000. Your total liabilities and shareholders' equity, $2,358,000,000. Okay, the balance sheet, it balances. So what does that mean? It means my total assets equal my liabilities in shareholders' equity. Okay, what's shareholders' equity? It's another accounting category that you add to liabilities for your balance sheet to balance. For this class right now, and for the level of accounting that we're going to get into, for this lecture, we're not going to cover shareholders' equity, but we are going to note that this balance sheet, it's called a balance sheet, balance sheets, balances, and your total assets plus liabilities and shareholders' equity equal each other. Okay, the balance sheet. I'd like to talk about, now that we're talking about the income statement and the balance sheet, now that we're talking about the income statement and the balance sheet, I'd like to talk about a basic accounting principle. This is not an accounting class, right? You'll have to take those, or you might have to take those. Accounting's my thing. You can tell I kind of can get a little bit overly excited about it. But when you're recording information into a financial reporting system, some software, some Excel. I mean, if you had a tiny little mom and pop business, maybe it'd be QuickBooks. If you had a very sophisticated organization, it would be called an ERP, an enterprise risk risk processing system. Call it a general ledger. When you're entering financial information into a financial reporting system, in accounting, you're recording, and you're going to hear this. Maybe you've heard this before, but you're going to hear it. So whether or not this is boring or whether or not this is something you're interested in, you're going to hear it. So remember this. I've got some ink all over my hand. Pen blew up. Accounting is recorded into financial reporting systems based on a series of debits and credits. And debits and credits equal each other. A debit of 100 must be equaled by a credit of 100. And that's also something that ties back, that kind of triangulates back to this concept of the balance sheet, how the assets plus the liabilities and shareholder equity equal the total liabilities and shareholders equity. So this concept of the balance sheet and the debits and credits balancing. But if you're interested, we can talk in office hours, or perhaps if you guys have an interest in getting into a little bit more in what debits and credits are and kind of why they balance, and what a debit and a credit would be for like the income statement, recording revenue or a cost, or recording a debit and credit for an asset or liability, we could get into that. But given that this is a course based more on broad finance and not specific accounting, I'm just going to throw out the terms debit and credit, because just those are the way you enter numbers into financial reporting systems. They're called debits and credits. Okay. We're now going to get to the statement of cash flows. If you were in a debate, or if people were around drinking a beer or coffee, a glass of wine or diet soda, and they were having an argument about what's the most important financial statement. You know, you've got three main ones to choose from. You've got your income statement. That's what happened. That's how much revenue or sales did you generate, and how much did it cost, and then how much are your earnings, and what was your EPS, earnings per share, right? What's earnings per share? It's your net income divided by your shares outstanding. What's a share? It's your ownership interest in that company. If you had all the shares in Portillo's or in Zoom, you don't own the whole company. And the stock price, right, multiplied by all the shares is the market cap, or in other words, how much that company costs, right? And Zoom was like 23 billion. Portillo's was like 800 million, right? So if you're having this debate, what's the most important financial statement, right? Well, you have three main big hitters. You have your income statement, which we just went through. We looked at Portillo's and we looked at Patrick, and maybe we'll look at Zoom, or look at Zoom's cash flow. Okay, cash flow. Oh, that's the third one. Cash flow. What is cash flow? What does it mean? What are the three main categories? If you've got just a good fundamental understanding of the concepts of what an income statement is, and what a balance sheet is, and what a statement of cash flows is, you will have reached a level of superiority among or over your peers that will carry you powerfully over the rest of your life and careers. To be able to articulate in basic terms what these things are is so important. A lot of people kind of know what they are, but it should kind of be like in their blood, and they should have a natural feeling about it. Okay, you know, an income statement is what happened, right? And then breaking it down a little bit more, how much did you sell, how much did it cost, and then how much did you make in terms of profitability, or how much did you lose? Let's say you sold $100 worth of stuff, but it cost you $150. So you lost $50 right there. Like, right? So I'm selling burgers for $10, but each burger cost me $15 to make. Now, you wouldn't want to do that, but sometimes a company gets in a situation where they're losing money, and they're losing money because their expenses are greater than their sales or their revenue. And then the balance sheet, right? The balance sheet's what you have. Two types of what you have. There's what you own, and then there's what you owe. What you own is the asset, right? What you owe is the liability. You've got short-term assets, call them current assets. You've got long-term assets. Short-term is something that is going to turn into cash within 12 months. Long-term is something that's going to stay there and it's going to be productive for you, like equipment. And then you've got liabilities. And then another example of an asset, right, is accounts receivable. That's stuff that you've sold, you haven't received the money, but it's an asset because it represents cash you're eventually going to get. That's accrual accounting, right? It's accrual accounting. Another example of accrual accounting on the balance sheet, get back to something that you bought but you haven't paid the cash for, is accounts payable, right? I want to go back to the income statement, but I don't, it's just staring at, right? It's probably stare at something like that too much. Get you cross-eyed. We're gonna have to go back to it though, because we're gonna go to the cash flow statement. So hang on, bear with me. Cash flow statement. So if you're having this debate about what is the most important financial statement, some might say it's the cash flow statement. I would tell you, I don't want to be lame, but I would tell you need all three. But I would tell you that the cash flow statement is interesting because it really triangulates all of what's going on in the income statement and the balance sheet in one story. Now, let's pull up more than a few cash flow statements. And you know, folks, you know, here I'm on this SEC website to get these financial statements from the 10Qs and 10Ks. You know, there's a lot of ways where you this is the official repository for it, but you know, let's say I want to go, a lot of these public companies have you know, websites where they have an investor relations department, and then that investor relations department has all the stuff that the SEC website has, but more, and they make it all cool and good looking. And I'll show you. I mean, let's go to Tesla, right? I'm just going to Google Tesla. Okay, Tesla. They make those electric cars. What? Oh wow. I'm not sure if I'd want an electric car because I don't want it to run out of juice, and I don't know if I always have a place to fill it up. But I like the self-driving. On a long trip, I like the idea of just like the car doing the driving. But I'm trying to find their investor relations department on their website. Contact, let's see here. This looks like the website for the consumers. I'm trying, investors. IR, what does that mean? Look at this, look at the address. IR means investor relations, IR, right? So documents and events. Look, quarterly disclosure, other documents. Annual report and webs, annual report, that, you know, that'd be the 10K that we talked about. Quarterly disclosure, right? Remember how we were going to these quarterly, oops, I think I just killed something. These are quarterly disclosures. So when Tesla has on their investor relations website where we are right now, IR, investor relations, quarter, Q3, remember there's 3 10Qs and then you have a 10K, right? The year end ones, they call it 10Ks. There's a lot of places where you can get information, but I can get an SEC filing, look, 10K and 3 10Qs from Tesla's website. And I also can get their shareholder deck, which is just a presentation that Tesla's investor relation department puts out about how they did and how they did and what they have. What's how they did and what they have. How they did is the income statement, right? What they have is the balance sheet. So Tesla I can't tell you last time I pulled up any of their financial statements. I'm flying blind. Let's see how I do. Okay, they start with their balance sheet and then they go to their income statement. Unlike the other two examples, or no, unlike Patrick that started with their income statement and then went to the balance sheet. So Tesla's got their balance sheet, you got their assets, the liabilities. Does it balance? Well, let's see here. Assets of 57 million, then liabilities of 29 million, plus stockholders' equity of 27 balances to 57,834, 57,834, 57,834. And this is for the balance sheet. Another thing to point out about the balance sheet is you've got 1 year next to the last period from the previous year. So what does that mean? Well, this is Q4, December 31st, 2020 versus the third quarter. But so during the year, you know, they're going to have they're going to have the quarter previous, which would be June. It's going to be, you're going to always see the December, but then you're going to have a new quarter here. Income statement. Okay, what was that third one? Cash flow statement. Okay. The cash flow statement, there's one of the most important things to remember. One of the things that you want to remember, and this will be like an exam question, right? This will be an exam question. What are the three components of the statement of cash flow? You've got an operating section, you've got an investing section, and you've got a financing section. Before you even go into what those three sections are, what is the statement of cash flow? So remember we were talking about accruals earlier, and what is an accrual? Accrual is the accounting term for recording an event as an asset or liability before the cash has been received, right? So, you know, let's say my plant workers have worked for a week, but they haven't been paid. Well, I'm going to record a short-term liability, right? Or let's say I bought $1 million worth of cabinets, but I haven't paid for it. So I'm going to record $1 million worth of accounts payable. That's an accrual. Or I've sold $1 million worth of stuff. Let's say I've sold $1 million worth of cabinets, but I haven't received the cash. I'm going to accrue $1 million accounts receivable. Okay. So given all these accruals, there's got to be something that says, well, hey, how much cash did you guys actually collect? Right? Okay. You know, so you said you had revenue of $100 million, and how much of that did you actually collect in cash? And not only are they going to ask that question, the investors, because the investors are using this financial information because they're reading the financial statements, right? And then they're going to use that information to determine how your company is in terms of its financial health and its profitability and in terms of the assets. And then they're going to take that information and they're going to make a decision about what your company's worth. And that's going to be reflected in the stock price, right? And the stock price times the shares outstanding. And what are the shares? That's the ownership interest in the company. The stock price times the shares outstanding is what the company's worth. And that's what's called the market cap, okay? But in order for them to make those decisions, for Tesla to be what it's worth, or for Zoom to be what it's worth, or for Portillo's to be what it's worth, or Patrick to be what it's worth, they've got to look at the report card, the data, and those are the financial statements. And the last one is called the statement of cash flow. So we're going to go look at it. It's one of the important ones, okay? This is a statement of cash flows. What is the statement of cash flows? Why do we care? Well, the statement of cash flows begins with net income. Now, we already talked about net income, right? We already talked about net income because we already talked about the income statement, right? We already talked about the income statement. The income statement was what happened. What did you sell? How much did it cost? And how much money? So for the 9-month period here, it said net income of $163,895,000. So the statement of cash flows begins there, and that's the operating section. There's 3 sections in the statement of cash flows, okay? There's 3 sections in the statement of cash flows. And it is the operating section, cash flows from operating activities, or just call it operating cash flow. Operating cash flow is the first one. That's the first one that comes. It's probably the most important one, because what does this do? It says, okay, I said that I made 163,895,000. Okay, do you see that right here? I said that I made 163,895,000. And where did I show that? Where did I show my work? Well, on the income statement, right? I showed that up in the income statement. But now the investors are saying, great, but how much of that was cash? And I want to know all the ins and outs. Because remember how we were talking about accruals? That's where you record an asset or a liability before you've actually received the cash. And that's the difference between accrual accounting and cash basis accounting. The rules for accounting, if you're a publicly traded company, like Zoom or Tesla or Portillo's or Patrick, the rules under US GAAP, generally accepted accounting principles, right? And that's the SEC. We're at the SEC website, remember? They come up, they require the companies to put out those 10 Qs and Ks 4 times a year, 3 Qs, 3 10Qs and 1 10K. Okay. They require accrual accounting. So if you're a private company and you don't ever want to go public, you don't want to ever become traded on the stock market, if you're a mom and pop burger shop, you can record your accounting on a cash basis accounting. No one's going to take away your birthday for that. You're not going to get in any trouble. But once you become public, you're on the stock market, you got to play by the rules. And the rules are determined very, very specifically, the accounting rules. It's accrual accounting, and it's determined by the SEC. And this format, there's no ifs, ands, or buts. I mean, there might be some minor differences, but generally everybody's got to do it the same way. And that gives you comparability, right? Apples to apples. Because before the SEC was established, these companies would do a lot of different things in different ways, and it was apples to oranges, and so investors didn't have comparability, right? But here, if Tesla says they made $100 million in net income, and then their competitor said they made $100 million in net income, the investor would be able to say, oh, they made the same. But back in the day, that 100 million meant different things, because there were some accounting procedures that didn't align one company to another. Okay. Statement of cash flows. So statement of cash flows. Why do we have a statement of cash flows? Why is it important? Statement of cash flows tells the investors how much cash a company generated based on 3 specific areas. And again, those areas are operating, investing, and financing. Okay. Operating cash flow at a high level is it begins with net income, and then you tell the investors the ins and outs of cash you collected or didn't collect based on certain categories. Investing activity, that is cash that came in the door or went out the door based on investments you made. And investments are buying equipment, buying companies, selling equipment, selling companies, okay? Your operating activities are income statement and balance sheet based, okay? This is your income statement. These are changes in your balance sheet, and we're gonna get into it. Believe me, we will. You're investing. These are investments you made in your equipment, your machinery. Maybe you purchased another company. Maybe Portillo's buys that mom and pop shop down the street, and they pay $10 million for it. Well, it's gonna show up here in investing. Financing. What is financing? Financing is the debt and other equity related activity. And equity, we really haven't gotten into that term, but you can, just as you can get money when you borrow, you incur debt, right? When you borrow, you incur debt. When I let's say I'm a large company and I need $100 million. So I issue some bonds, some debt, I get $100 million. I can also sell stock. I can actually go to the market and sell more shares of my stock. So Remember how we were talking about market cap, how much a company costs? We were talking about stock price, and we were talking about shares outstanding. We were talking about how you take the stock price multiplied by the shares outstanding, and that's how much, so Portillo's is worth $800 million. That's how much you'd have to pay if you wanted to buy them. And it looked like Zoom was worth like 32 billion, right? Just as you can buy shares, you can also sell shares. So a company could create some new shares and receive cash. Okay, so that would be an example of a financing activity, because the concept of financing activity is how a company gets cash other than selling its products. So what does that mean? Okay, well, it means Portillo's gets cash, it generates cash by selling hamburgers, right? And then, and of course, it's going to record some expenses, and then it's going to have some cash left over. And that's what's going on in the operating section of the statement of cash flows. And then it's going to be adjusted by the cash it either had to pay or the cash it has not yet received by the accrual accounting. Remember, we were talking about the accounts payables and accounts receivables. Accounts payables is when you bought something, you haven't paid for it, and accounts receivable is when you sold something and you haven't received the cash. Okay, those are going to be adjustments that get you to your final cash in the operating section. Okay, that's all based on sales and operations. But financing is where you either get cash or you have to pay cash based on your debts, but not your operating debts like accounts payable, but your debts related to bonds, borrowings from the bank. Think of it that way. A bond is a borrowing from a bank, unlike accounts payable, which is like my payment to a vendor, right? So if it's bank related payments and repayments or receipts of cash from borrowings, then it goes in the financing section. So the financing is not like your operations in terms of like Portillo's selling to a customer, and then Portillo's buying burgers and then paying the vendor. That's all operating. That's the operating story of the cash flow. We'll get to that. Okay. The financing is if they borrow and receive cash, and then they pay that cash back later when they pay back the debt borrowing, that's financing activity. Or if Portillo's were to sell more shares to the public on the stock market and receive like another $100 million and then use that cash to invest in the business, that's financing activity. Okay. There's some other ins and outs on financing activity. But if if you could think about one thing, think about receiving cash for borrowing in a debt market, okay, or paying back that debt. Remember? And remember when we were looking at the balance sheet, we were talking about short-term liabilities and long-term liabilities, and debt. We're looking at Patrick's balance sheet. Was the predominant long-term liability? Okay, so when Patrick issued that debt and got that money, it would show up in the statement of cash flows as pluses and minuses, and we'll get into that. And then investing, so you got the operating, you got the investing, you got the financing. The middle one that's called investing, it's kind of a misleading term, because what you mean, it's like a stock investment? Well, it could be, but most of the time when you're talking about the investing section of the statement of cash flows, you're talking about expenditures for equipment. They call that capital expenditures or CapEx. Okay. And then business acquisition. So if you bought a company, that would be another example of an investing activity in the statement of cash flow. So you've got operating, investing, and financing. Financing is the receiving of cash for borrowing in the debt or the bond market or paying it back. Okay. Companies also have like a credit card type arrangement, like a big credit card arrangement called a revolver. It's kind of like a revolving door. You can borrow and then you pay it back. You borrow and you pay it back. You use it for your daily cash management purposes. That also shows up in financing, because that's also a form of debt, but it's short-term debt. And then investing would be like when I buy $10 million worth of equipment, right? Or I buy a building, right? Or I sell the building, or I sell the equipment, or I buy a business, or I sell a business, right? If Portillo's buys the mom and pop burger shop down the street for $10 million, it's going to show up in investing. If Portillo's borrows from the bank $100 million, is going to show up in financing. But then if Portillo's sells stuff and incurs expenses, and it has changes in accounts payable and accounts receivable and inventory, that's all going to show up in a schedule in the operating section. Okay, and we're going to get to that. We're going to get to that right now. I'm going to go through the operating, the investing, and the financing sections in the statement of cash flows. We're at 1 hour and 50 minutes. So another 50 minutes. And we're just sticking with the financial statements. But this is kind of like, this is the meat and potatoes. I mean, if you don't understand, if you don't understand the financial statements, then you're kind of, the plane hasn't lifted, gotten airborne, you know, because this is because if you ask the question, how do investors come up with the share price? You know, how does a company even, what is it worth? Because it's the financial information. And the financial information is what happened, what do they have, and then how do they generate their cash? And by that information that's released 4 times a year, you know, the investors and the analysts, they build their models and bring it into modeling and all that kind of stuff. But you got to get the basics first. Where do they get their information from? They get it from these SEC filings. And what are those financial statements? The income statement, the balance sheet, statement of cash flows, right? What's the income statement? Well, it's what happened. How much did I sell? How much did it cost? How much did I keep at the end? Or how much did I lose? How much did I keep if they're profitable? What's my EPS? Then the balance sheet. My assets, what do I have? My liabilities, what do I owe? And it balances, right? Your assets equal your liabilities plus equity. Balances. Debit and credit, right? Those are the terms for the accrual accounting entries, the debits and the credits. Accrual versus cash, right? What's accrual versus cash? Accrual is I record the event before I receive the cash because that economic thing, that reality happened. I just haven't received the cash for it yet. And then that creates a need for the investors to have to see, you have to show the homework, right? In the operating section, you have to show the homework. They need to say, okay, you say you earned this much money, but how much cash did that result in? And that's what we're going to get to in the investing section. I'm sorry, in the operating section. Got operating, got investing, and finance. What's the financing? The financing is remember, it's how much cash did you receive from borrowing in the debt market, okay? Or how much cash went out the door to pay back that debt, right? It could be short-term or long-term. And then in the investing section is machinery and stuff that you bought, right? Because that doesn't show up as an expense. Actually, it's parked on the balance sheet as an asset and it's bled off later in expense by depreciation. We'll get into that. Or if I bought a company, that would be cash out the door that would show in the investing section. Or if I sold a company. So if I'm Portillo's and I bought the mom and pop for 10 million and then a couple of years later I sell it for 15 million, that'd be a source of cash or a good guy cash in the investing section. We're gonna get to the operating right now. We're talking about the operating, we're talking about the investing, we're talking about the financing. And when we've finished our discussion of the statement of cash flows, we will have covered the 3 core financial statements that you need to know for the rest of your lives in business. And that's the income statement, that's the balance sheet, that's statement of cash flows. We get the statement of cash flows right now. Okay, share screen. Okay. What are the 3 areas in the statement of cash flows? They are operating, okay? Operating, investing, and financing. Okay, every morning when you wake up, write down, there are 3 aspects in the statement of cash flow: operating, investing, and financing. Or you should be able to just, you know, write on your hand in permanent Sharpie. Maybe you just end up waking up and you just know, like Jim keeps asking us what the 3 aspects of the statement of cash flow are, and I know that in my sleep. It's operating, investing, and financing. Operating. So we start with net income. Now remember, this net income, we already looked at this net income because remember, we already looked at the income statement. Remember? 163 million. Because what's the income statement? The income statement is what happens. What did you sell? How much did it cost? And how much money do you have left in the end? So we start with the income. But the investors are saying, okay, 163 million, how much was that? How much of that was cash? Well, some of the expense in there that result, because remember, revenue less expenses are profit. We're saying that that's our profit. Depreciation and amortization, that's an accounting term that describes when you buy equipment, you don't expense it all at once. You bleed it off over time, and it's called depreciation and amortization. Okay, we won't need to get into it, but it's a non-cash expense, meaning I'll never have to pay that bill. You know, I paid the bill down here when I recorded the capital expenditure, and that's when I buy the machinery and equipment. But then later on, it bleeds off into the income statement, and it's what you call a non-cash expense. So I add it back. It's a good guy. It's a positive. I add it back. Stock-based compensation expense. Okay, sometimes I pay some of the executives in shares of stock, and there's no money there's no cash, but I have to record an expense. That's a non-cash expense. Some other non-cash items. Okay, some taxes that I incurred, but I didn't have to pay yet. Okay. We don't need to get into the ins and outs. Don't let these terms scare you. They're a little bit weird looking, but it's just when we're looking at the income statement up here, there's the revenue, cost of goods sold. There's some expenses in here that I'll never have to pay cash for. So I add them back here in the operating section. Okay. And then now this is the stuff this stuff up here is a little bit tricky. You kind of need to know the accounting. So don't worry about it. Focus on this. This is the changes in the balance sheet. Remember we were talking about the balance sheet, how you use accrual accounting to record like your accounts receivables for when you sold stuff and you haven't received the cash, and down here in accounts payable when you bought stuff but you hadn't paid cash for it yet. You know, you bought all the cabinets, you got them in your warehouse, but you haven't paid the bill yet. So you got accounts payable. So what the statement of cash flows is doing here, remember inventory? Remember we were talking about inventory, $485 million of inventory, all that stuff that we have. Now, because I have the inventory, I incurred accounts payable down here, right? I got the stuff, I just haven't paid for all of it. So for the stuff I haven't paid, so I've got $485 million of inventory, but look I've got $219 million of it. I haven't paid for that yet. That's accounts payable. That's a liability. It's a short-term liability. So what the statement of cash flows is doing is it's saying, okay, you jokers said you made $163,895,000 up here, that income statement. Some non-cash things that are good, but then during that same period, you had to pay down $142 million of accounts receivable, or I'm sorry, your accounts receivable went up $142 million. Now, what does that mean? That means you had some I will soon pay you things, which are called accounts receivable. Remember, I sold $1 million worth of furniture down the street. Okay. They received it, but they're going to pay for it a month from now. Okay. And so in my sales up here of 2.9 billion, what I'm saying on the statement of cash flows right here is that there's 142 million of that I didn't get cash for on a flex basis. So they're basically saying relative to the beginning of the year, I have not been paid an additional 143 million. And so this is a use of cash right here. So I'm basically saying, okay, I said that I made 163 million. These are positive add backs because these didn't burn any cash. But this revenue relative to the revenue that I earned up here, this 2.9, 143 million, no cash collected yet. And now prepaid expenses. Oh, sorry, let's go. No, inventory is the next one. Inventory, it's negative 127 million. It's a negative 127 million. On a statement of cash flow, the positives are called sources of cash. The negatives are uses of cash. And so looking over here, it's a negative 127 million on inventories. What that means is when my inventories go up, I'm paying cash. And so that's a bad guy. It's a negative in the statement of cash flows. When my receivables go up, that means that I'm not receiving cash. I'm selling, but I'm not receiving cash. That's also a negative. We're reconciling down to how much cash we actually really received at the end of the day. We're gonna get to the next thing that is a good guy here. Right here. Accounts payable, accrued liabilities, and other. It's positive. It's 146,812,000. Why is that? These are negative. So this is inventory. I bought more inventory. I used up some cash. I did some sales and I haven't received the cash yet. And so that's a use of cash, negative, from my AR, my receivables. We talked about AR up here, right? It's an asset right here. Receivables, when you've sold something, you haven't received the cash. So changes in my receivables means my receivables went up from the last period, right? Right here. And that's a 143 million bad guy. And then my inventories went up from the last beginning of year period, right? Inventories. So we had inventories of 312 million, then it went to 485, right? And the difference is 143, no, I'm sorry, 127. So inventories went up, and that's a use of cash. It's a bad guy. It's negative. On the other hand, accounts payable, accrued liabilities, and other. My liabilities, look at accounts payable, accrued liabilities, and then other. Liabilities in the beginning, the end of year period, liabilities at the end of this period. When liabilities go up, that's a source of cash. Why? What does that mean? What do you mean liabilities go up? Well, think about it this way. If I am receiving the benefit of goods, but not paying cash for them, and then I'm able to take those goods and then go and sell, that actually represents a source of cash. In the statement of cash flows, when a liability goes up, it's a good guy for you in your operating section. It's a source of cash. When your asset goes up, your short-term assets such as inventory or accounts receivable, that's a bad guy. So think about it this way. If you're thinking about your balance sheet, you're thinking about your statement of cash flow, because this is why the statement of cash flow ties everything together, because it starts with net income. That's the income statement. Remember, that's the first thing. Then it goes to the balance sheet. That's your assets and liabilities. Remember, the balance sheet balances your assets equal your liabilities and shareholders' equity. The statement of cash flows begins with net income. That's your income statement, right? And then there's some non-cash adjustments, and we're not going to really get into that because that's a little bit more detailed accounting, important, but a little bit more detailed than we need to really get a fundamental understanding. 2 hours and 3 minutes. But the balance sheet, those things that are like fairly visible, like your accounts payable, okay, those are bills that you're going to pay to your vendors. Your accounts receivable, those are IOUs from your customers, right? Inventory, right? We know what inventory is. It's stuff that you have that you're going to sell, right? Your accrued liabilities, we're talking about accrued payroll, right? A week's gone by. We haven't paid our folks yet. We're going to pay them a week from now, but we still have to accrue that liability because we're not a cash basis. Because the SEC, Securities and Exchange Commission, has created US GAAP, generally accepted accounting principles. We get those are set in stone rules. There's no way around them. You got to do it 100%. You're going to get audited, right? You will, not by the IRS, but by your auditors. You actually have auditors that specifically look at your books and records. We'll talk about that later. Okay. So the operating section of the statement of cash flow, that's really where all the action is, okay? So everybody knows what your operating cash flow is, okay? And they're looking fundamentally at your net income, right? And that was the result of your revenue, your expenses, and you get your net income. Remember, your net income divided by your shares outstanding is your EPS. EPS is what all the analysts look at, right? So think about it like you're an ESPN analyst, and you say, hey, I think the Broncos are going to beat this team by this and the over under, and then everybody, all the analysts, on ESPN, let's say there's a dozen of them, right? Well, there's a dozen of them for Tesla, but the over under they're doing is the high and low EPS. So you have one analyst, Sally says, okay, I think it's going to be $3.12 a share, and then Joe's like, no, it's going to be $4 a share, and then Jane says, no, it's going to be $1 a share. So you've got your low, your high, and you've got your consensus. Your consensus would be the average, all that. It'd be like the Vegas odds, okay? But they're analysts, they're professional, so that evaluate the financial results and predict the EPS. They don't know, but they have a prediction, right? So you have the income statement, and then you've got the balance sheet. So the changes in the balance sheet then determine the negatives and the positives, and we'll what are these negatives and positives? So see, this is a negative, that's a negative, that's a positive. Okay, so when the short-term asset goes up, it's a source of, it's a use of cash. I'm sorry, share. So negative, negative, positive. Okay, negative. When the short-term asset goes up, it's a use of cash. When the short-term asset goes up, it's a use of cash. When the short-term liabilities go up, it's a source of cash. It's a good guy. Use of cash, source of cash. This is, I'm telling you, of all the aspects of accounting, the statement of cash flow is the hardest. And the concepts are weird. What does he mean by source and use of cash? What does he mean by good guy and bad guy? Well, by bad guy, I mean it's a negative and it reduces it. And by good guy, I mean it's a positive and it increases it. And if you can think about it in this term, if your short-term liabilities go up, it's a good guy or a source of cash. If your short-term assets go up, it's a bad guy or a use of cash. We'll meditate on this. Maybe by the second or the third class, we've gotten a little bit clearer on this. We'll look at more statement of cash flows. Your net income, that came from your income statement. We already discussed that. Then we also talked about what were the three sections of the cash flow statement. You've got your operating, your investing, and your financing. And your investing was when you buy equipment and machinery, right? You don't expense it up in the income statement. You record it as a long-term asset, and then later on, you record a depreciation and amortization expense. We saw that. We'll see this in the statement of cash flows. It's depreciation and amortization right there. It's a non-cash expense of 76. And it's a non-cash expense because we already recorded the cash outflow here, this period, the capital expenditures. That's when you buy the machinery and equipment. Business acquisitions. Okay, business acquisitions. Patrick buys a lot of businesses. So they spent, $297 million for the year on business acquisitions. And those, you don't expense that. That's an asset. Those are assets, right? That's an example of an investing activity. So to think about investing activities, it's when you buy long-term assets, right? It's when you buy long-term assets. That activity does not show up here in the operating. Because operating is about the income statement, your non-cash add backs, and then changes in the balance sheet. And when your short-term assets go up, it's a negative impact on the operating, and when your short-term liabilities go up, it's a positive. You get total operating cash flow of 147. So you started with 163 million, you had all these items, now you have 147. And then the cash that went out the door for investing, that doesn't get recorded in the income statement because it's balance sheet only, was 343 million. Then your financing activities, there's a lot of different terms here, but the way we summarize that, it's bank, it's when you receive money from some bank borrowings, whether it's debt or short-term revolver, or when you pay back that short-term or long-term debt. Just think of it that way. Think of it think of the statement of cash flows in three main areas. You're operating. You begin with your net income, which was the end result of your income statement. Your income statement was your revenue less your expenses. That's your profitability, right? Then your non-cash adjustments. And then one good example of a non-cash adjustment is your depreciation and amortization. Depreciation is, okay, you buy some equipment, but you don't expense it all at once. If you pay $10 million for the equipment and it's a 10-year asset, you record 10 years of depreciation, right? So it was $10 million. It's going to be 1 million of depreciation a year. And that's going to hit your income statement, but that's not actual cash expense. The cash was recorded in the investing section. And then the expense was later bled into the income statement using depreciation. Or when you buy a business, let's say I buy a business for $50 million or something like that. That's not an expense. It's a purchase. It gets parked in the balance sheet as an asset, right? And we already saw the assets in the balance sheet. There's going to be some equipment and there's going to be some other assets there from the business you buy. The financing section of the statement of cash flows, bank borrowings and repayments. So what was the point of looking at these financial statements today? Like why do we care? Why am I getting all excited about this? Well, what I'm getting excited about is the companies, right? The activity, the story behind the company, and a company is people. It's people and it's equipment and it's more people, the customers, right? And it's the people that buy the shares and it's the people that think about the shares and you know, we'll go to a website right now called investing.com. Free website. Share the screen. Look at this. So lot going on here. I'll just start to talk about it. I'll just tell you what I'm thinking. You've got all these stock market indexes, and what those indexes are is it says US 500. That's the S&P 500. That's the top 500 stocks in terms of their market cap. They match them all up together in a big basket of 500. And then this is the graphic presentation of the prices of all those stocks, of those companies together. S&P 500, and it's the top market cap. Now, you guys I'm not sure how many folks knew what market cap was before today's class, but we know what market cap is now. Market cap is the price of the stock times the shares outstanding. Price of the stock, $69. Times the shares outstanding gives you the market cap. Oh, but what was the reason why we want to go to investing? These are some stories. Look at Visa, MasterCard suspend operations in Russia over Ukraine invasion. I mean, these are real world events that are affecting publicly traded companies like Visa and MasterCard. Look that's the ticker. Remember we were talking about the ticker symbol? That's a ticker symbol for Visa. This is a story, you know, obviously anybody reading the news, this is horrible war going on between Ukraine and Russia, affecting the lives of millions of people. And well, what does that do? That affects the stock market. And so it all boils down and back into really when it affects the stock market, what you're saying is it's affecting this, remember? Because the stock is represented by the activity and the stuff that a company has, right? Well, what's the impact of the war here, right? This article. But what they're getting down to is they're saying, okay, these events are affecting Visa and MasterCard. right? Visa, ticker symbol is V, right? And their stock price is 200. And then their market cap, and the market cap is the stock price times the amount of shares outstanding, and the share is an ownership interest company. If you own all the shares, you would own all of Visa. Market cap of Visa is 25.4 billion. Anyway, so Visa stock is down 3% or down $6 or 3% because of the impact of the war. Well, why would the stock? Well, because what happened was that the income statement and then the balance sheet are affected because of some economic activity that Visa and MasterCard can no longer carry out in Russia because of the sanctions, right? So Visa, all the credit card terminals, MasterCard, all the credit card terminals in Russia, suddenly zilch, nothing. That affects revenue, that affects, expenses. Maybe they still have to operate all their businesses there, but they can no longer sell things, right? That's like Portillo's keeping on the lights every day, even though they can't sell burgers anymore, right? So, and then that's going to affect their balance sheet because maybe they have assets that are no longer useful. And so they will have to scrap them or because they're not generating revenues in Russia, they're going to have less cash, and cash is on the balance sheet, right? So go into investing.com because you think about, okay, the financial statements, why do I care? Well, they tell a story. I mean, look at this. This is a story right here. Visa and MasterCard. Situation in Ukraine. Stock prices going up and down because of this. And investors are saying, what impact is this going to have on their income statement and balance sheet and statement of cash flows? That's why those financial statements are important, because they value, what other companies are in the news? There's a story, natural gas heading for $3. That's a commodity story. But Facebook. So Facebook's really taking it on the chin, I'll tell you that. Look at this. Their stock was at $325 and dropped all the way down to $200. I mean, it was at $325 in February, and wow. So there was probably some news that Facebook released. There was some news, and I think it was related to kind of like the advertising they receive on Facebook, and they really changed their strategy, and they said, we're no longer going to be doing this, we're going to be doing this. And investors said, oh, well, what that's going to mean to your income statement is your revenue is going to go down. Maybe not forever, but the new thing that you're saying that you're going to do, well, seeing is believing, okay? But we do know that you're telling us now that the stuff you used to do that used to generate all that revenue, the sales, income statement, no longer going to happen. So that affected the stock price because the investors use the income statement, the balance sheet, and the cash flow statement it's the only information they have, right? Because their companies are in business to make a profit, and then that values the stock. And so in this instance, the investors said, okay, your stock's worth $325, and they multiply that by the shares outstanding, and they say that Facebook's case right now, they're worth 118 billion. So that's how much you'd have to have if you wanted to buy Facebook. But in February, they thought the company was worth a lot more based on all the information they got from the income statement, balance sheet, statement of cash flows. And Facebook made an announcement. They probably released some financial results, some new financial information, and then they gave some forward-looking statements. And they said, oh, by the way, okay, over the last 10 years, we've made this advertising revenue by doing this one thing, but we're changing our whole strategy going forward. Well, all the analysts put in their predictive models using the spreadsheets to say, okay, revenue is now going to be this, and expenses are now going to be this, and here's profitability, and here's how it flows to the balance sheet, here's how it flows to the statement of cash flows. And then Now here's where we think the stock is. Here's what we think the company are worth. And we think now the stock should be worth $200, which would give it a market cap of 117 billion, which is what it's worth. And before we thought it was $325, or let's call it 200 billion of market cap, it was worth 200 billion. And so the relevancy of the financial statements tie all the way back to the value of a company. And if you're a publicly traded company, your stock trades on the stock market and has a share price. And then there is EPS that you get from the income statement. And then the analysts have expectations of EPS, expectations of operating cash flow. And real life events are affecting and impacting the income statement, the balance sheet, statement of cash flows. We just looked at, just randomly, I picked up investing.com. The article I picked up 3 hours later had already changed. And that was about Visa and MasterCard and war in Ukraine. They can't use their terminals in Russia right now because of the sanctions. So that affects their revenue, balance sheet potentially, statement of cash flows. Because of the impact on those three financial statements, the company's value goes down in this instant, and the stock price goes down. And the stock price goes down because of the information present, or the implications of the information that will be in the income statement, the balance sheet, and the statement of cash flows. I talked about the 10 Qs and Ks. Remember, if you're a publicly traded company, Securities and Exchange Commission requires 4 reports, 3 quarterly and 1 annual. And the quarterlies are called 10 Qs and the annuals are called 10 Ks. Right before the 10Q and the 10K, the companies also have what you call earnings releases. And those are less formal, less regulated. They're still following all the accounting rules, but there's a little bit more spin and a little more stuff you can say. And those are called earnings releases or press releases. And I thought, as we're wrapping things up, to just give another example of periodic financial information, stuff that's going to affect the stock price because it's an update to the financial statement information, right? The income statement, the balance sheet, and cash flow. I want to look at an earnings release. And I think we're going to choose Tesla because I've got the Tesla website. So share screen. Let's go to the Tesla. So remember, SEC filings, they've got the Ks and the Qs right here. Q&A, that's question and answer with the analyst. There'll be like a transcript there. You can actually listen to that stuff. Shareholder deck. We'll open up the shareholder deck too. We've still got 18 minutes, and I got a press release. Let's do a press release for Tesla. What's that all about? Austin, Texas, great place. So they basically said in the third quarter, we produced 238,000 vehicles, delivered over 240,000. Okay, this is a short and sweet press release, not very exciting. Okay, let's see. What about the shareholder deck? Q3 2021 update. Okay, this has got a lot more information. There we go. They talk about how much cash they have. They talk about the profitability. They talk about what they did, how many cars they made. Oh, look at it. Revenue. Remember, they're talking about income statement. Look, revenues, we already talked about that. Gross profit, that's revenue less cost of goods sold. Some more expenses. Net income. EPS, there we go. We talked about EPS, there we go. Net cash provided by operating activities. There you go. Capital expenditures, we talked about that. Free cash flow, we haven't talked about that, but that's part of the statement of cash flows. Cash equivalents, we talked about that in the balance sheet. Revenue, profitability, and cash. Look at that. That's how they think about it. We already talked about it. They get into operational specifics about vehicle capacity and production and software and highlights. Photos and charts. Well, how can you not love photos and charts? pretty cool. Got some graphs. Financial statements. Woo! Statement of operations. Statement of operations, or other words, note ends the income statement. This is cool. So we did this kind of theoretical study of a few SEC financials, but now we're going on these company websites and we're picking up the investors deck and we're seeing, okay, what is this stuff? What is this stuff? What is this story? This is cool stuff. Let's take a look at this. I'm getting excited. Only 15 minutes left. Okay. Got the statement of operations, which is, your income statement. You got your revenue, you got cost of revenues, you got your gross profit, you got your operating expenses, your income from operations, your net income, and your EPS. You got your balance sheet. There you go. Assets, that's what you have. Liability, that's what you owe. Does their balance sheet balance? Yep, there you go. Look at total assets equal total liabilities and equity. Statement of cash flows. What are the three main sections of the statement of cash flows? Your operating, your investment, and your financing. Your operating begins with your net income. Your adjustments to the balance sheet and other non-cash expenses get you total cash provided by operating activities. Your investing activities, that's the equipment and businesses that you buy or sell. The equipment that you buy, another phrase for that is capital expenditures. Capital expenditures eventually make their way to the income statement in the form of depreciation later on, which is a non-cash add back. Look at, see, good guy. And then your cash from financing activities, generally that's just your bank borrowings where you get cash in your repayments, where you have to use cash to pay back. Your proceeds of issuance of common stock. Remember how I was telling you that companies can sell some of their stock and get more, because they can issue more shares of stock and get cash. What Tesla did right here. That's why it's a positive. That's kind of neat to look at that. And then Q&A, that's kind of interesting. The questions that the analysts are asking and the answers. So we spent a lot of time, got 2 hours and 27 minutes right now. We spent a lot of time just talking about three financial statements. We talked about the income statement. We talked about the balance sheet. We talked about the statement of cash flows. But kind of how we would think about like a construction foundation, you kind of pour the foundation first, and then you put up the walls, and then you build the flooring, you put up the roof, and then you build the interior. But you wouldn't kind of start the windows first without having poured the foundation. You kind of have to plan the work and work the plan. And in finance, essentials of corporate finance, all this stuff begins with the results, like all the modeling that we're going to talk about, the financial modeling and the spreadsheet use and the concept of evaluating investment decisions and all that good stuff. It begins with the financial results. And if we're not totally squared away and dialed in and tightened in with our understanding of the financial statements, the income statement, the balance sheet, and the statement of cash flows, it's like plane's not going to get off into the air. And none of these beautiful pages that we're going to go through and the real life scenarios are going to have any relevancy. So that's why it makes sense to spend 2 hours and 40 minutes just talking about the income statement, the balance sheet, and statement of cash flows. Now, why didn't I walk through a bunch of slides today on this? It's because, well, this is my life for 17 years. I started out auditing the publicly traded companies. I worked for an audit firm called KPMG, and we would go and we do the checkups on the health of the financial statements. We look for details, and we get the backup, we get the support, and we check it all out to make sure it's okay, give it a good bill of health. And then went on from the audit side and actually worked for the large, $60 billion companies, $18 billion companies, $4 billion companies, putting together the financial statements and SEC statements, and moved on to a lot of other different roles and responsibilities that I have now. But These financial statements have always been my world. And when I look at different companies, whether it's competitors or whether it's peers or whether it's just the Teslas, it's kind of neat for me to be able to just pick up a report and say, okay, there's my income statement, there's my balance sheet, and my cash flow. Here's what's going on. And I can just in a few minutes just, oh, I get it. And then there's footnotes of the financial statements, a lot of other information. We could probably talk about that in the next class or office hours or offline or whatever, if you have emails or questions to me. A little bit of housekeeping, I guess, towards the end. I now have an IU email. It is it's going to be up there in Canvas. I'm just fine tuning Canvas, doing my final touches on that, but it is JAEROSE at iu.edu. If you need to hit me up on my on my cell for a last minute kind of important question, something fairly urgent, you need to text me. It's 512-217-0394. Email is probably the best way if it's not urgent, but I understand last minute thing, you need to text me. Maybe you need to call me. Have to be a little bit more urgent if you have to call me, but again, I'm going to be having office hours. I kind of want to get your feedback on whether it makes sense to have office hours before class or after class or appointment only. And I'm willing to be open for all those possibilities. And then for the first, call it homework assignment, something that I'd like for you to do before the next class. I'd like you to pick a company that you're interested in, okay? And it's got to be a publicly traded company, so it's got to be in the stock market. And either by going to the company's website and pull, like remember we did for Tesla, we pulled up like the 10K and then the investor deck and then the earnings release. I'd like you to go to the company's website and I'd like you to pick a quarter or a year end, whatever you want. It could be Q3, it could be Q4, which would be the year end for most companies. And I'd like you to, create like a folder on one of your drives. And I'd like you to save, whether it's the PDF or the Word, the 10Q, okay, the investor deck and the press release, as much as you could find. So at a minimum, it would be the 10Q or the 10K. Maybe choose the 10Q because it's more bite-sized. If you really want to go overboard and you want that big book report, it could be the 10K. And I'd like you to look at the income statement, the balance sheet, and statement of cash flow. And I'd like you to write 5 bullet points on your observations. I looked at the income statement and it looks like they have a lot of liabilities, and those liabilities are related to the long-term debt. Where I looked at the income statement and I noticed that this company that I like a lot is not even making money. They have a net loss. So I'd like you to make some observations about the income statement, the balance sheet, and the cash flow statement. And do this ahead of time before the next class. Another housekeeping rule is you'll note on the syllabus, and the syllabus is going to be out there on Canvas, hopefully by the time we're all listening into this video. The book is nice. I know that you guys have, you folks have the electronic version, but for the reading assignments, the minimum expectation, and again, it probably won't be for this class because this is our introduction to all of it, is for the reading at a minimum, scan through each page. Just let's say you had a paper book. At a minimum, the expectation would be before class that you scanned everything, every single page, just turn, what are the concepts? And then some of you might be speed readers where you don't need to scan. You're going to read everything before class, read everything diligently. Maybe you're even taking notes, whatever your study habit is. But you should at least see what all the topics are quickly. Maybe you're taking little sticky notes you're taking notes, okay, I want to go back and read that. But recommendation is scan first before you read, because then you know how much reading you have to do and what the topics are, and you'll see stuff that, okay, I can skim through that. I know that. That looks like it could be interesting or important. Okay, so I'm going to note that. And then so if you've got 4 chapters for before one class, you get a chance to just scan through them first. That's one expectation. And then we'll have focus assignments about things that we really want to read. We're going to be doing some supplemental reading outside of the book, but this is a good book, and it's the idea of just seeing what's out there before every class is good, because then some of the terminology is not going to be new. And then the whole point is that the lectures are going to just give life to this stuff. Because I live in the real world and I work in the real world. Not that other people don't, but this stuff to me is real in everyday life. And I can show you and unlock and capture this. Well, we're about at time, folks. And I really look forward to meeting everybody in person. I had to have the first class as a recording, not because that's my thing. I actually have been in the office during the last 2 years. I've done remote very, very few days. I'm an in-person person. I'm going to be at a planning strategy meeting with the folks I work with. And we're actually going to be talking about a lot of the stuff that we discovered today. And it's going to be thinking about the impact of past results that we record in our income statement, balance sheet, and cash flow statement. And then we're going to say, okay, well, why did that stuff happen? What will happen? And what can we do to improve the business? What can we do to grow the revenues? And what can we do to just make the company healthy? But we're thinking about the financial information. All that begins with the fundamentals, the income statement, the balance sheet, the statement of cash flows. So look forward to meeting everybody in person. I think this is going to be an awesome class. And I'm very excited to meet everybody. I want to hear everybody's stories. I want to learn about your backgrounds, and I want you guys to ask questions and to be really interactive, because I mean, this is about learning. It's about challenging ourselves. We've got a textbook, but we've also got the real life stuff, and it'll be awesome. We're all in the class together and we're interacting, and it'll be great. So look forward to a fantastic semester with everyone, and look forward to seeing you soon.